Good morning, everyone. Here's your market update for the 11th of November. Let's start with the US dollar. So, although the dollar began last week on a strong note, its momentum faded later, ending with a mild downward trend on the weekly chart. The dollar index once again failed to stay above the key psychological level of 100, a level that's also aligned closely with a 200-day simple moving average. The main themes in the currency market were the US data vacuum and the uncertainty surrounding the Federal Reserve. The ongoing government shutdown delayed the non-farm payroll report, while weak private employment numbers and the collapsing Chinese exports further eroded the dollar's safe haven appeal. Right now, there's about a 60% chance that the shutdown will end somewhere between November the 11th and the 21st, though there's still a 15% risk that it could drag on until December. Markets are closely watching for any repricing of the Fed's rate cut expectations, especially after Chairman Jerome Powell's recent hawkish comments. US Treasury yields have been trending lower across all maturities, which doesn't favor well for the strong dollar. So a short-term rebound is possible, but given the dominance of the net short positions and expected rate cuts, the dollar's weakness may persist. So technically, the dollar index would need to go and break above the 100 and then above the 200-day average at 100.21. This would then turn it bullish once again. On the downside though, support lies somewhere around the 99 level, with deeper pullbacks potentially testing the 98.85 and 98.57 levels. So turning to oil. The US crude started the week trading just below 60 per barrel, with a slight gain on Friday amid rising geopolitical tensions and the US government shutdown. The shutdown has now become the longest in US history, affecting sectors like air travel and employment and heightening concerns about economic growth. Meanwhile, OPEC announced a small production increase for December, but suspended further hikes for the next year due to demand uncertainty. Saudi Arabia has also lowered its official selling prices to Asia, signaling an oversupplied market. From a supply and demand standpoint, the market is in a phase of ample supply, weakening demand, and macro uncertainty, all of which limit potential upside. Technically, crude remains in a downward trend, though the MACD suggests a possible short-term rebound. Resistance sits at 61.30, and if broken, prices could rise to 62.38. On the downside, support lies at 59, with potential weaknesses extending to 58 if that level fails. Next, we'll look at gold. On November the 10th, spot gold traded at around $4,100 per ounce, rising over 2.45% on the week. The rally was driven by a weaker dollar, a safe haven demand amid the US government shutdown, and renewed geopolitical risks. With Wall Street posting the sharp weekly decline, especially in the Nasdaq, the largest drop in over 7 months, investors moved away from riskier assets and back into gold. So ongoing conflicts between Russia and Ukraine, Israel and Palestine, and the Houthis' activity in the Red Sea have further fueled a safe haven bid. Technically, gold's close above 4,000 is a psychological level that again creates a bullish short-term outlook. To maintain this momentum, prices must hold above the 4,000 level for several consecutive sessions. The 14-day RSI has moved above 50, also suggesting continued bullish momentum. If prices can clear the 4,154 level, gold could test 4,200 and then potentially 4,250. Conversely, a break below 4,000 would bring on the 3,960 level, or even as low as 3,886 into view. Finally, the Australian dollar rose above 65.30 against the US dollar on Monday, extending gains for a second day. This was supported by comments from the RBA Deputy Governor Andrew Hauser, who stressed the need for tight policy to fight inflation. The Aussie also benefited from easing US-China trade tensions, as China temporarily lifted its export ban on key materials such as gallium and germanium, signaling a thaw in the relations. Meanwhile, China's inflation data surprised to the upside, with CPI rising 0.2% year on year in October, a small but positive rebound. Technically, the Aussie-US pair is consolidating between the 64.40 and the 66.15 mark, with a midpoint of around 65.30. The RSI near the 51 suggests that there is still room for further upside. Immediate resistance is somewhere around the 65.56 level, and a break above that could open the way to 66. Support lies near 65 and then 64.50, and then even deeper at 64.14. Overall, the Australian dollar appears cautiously optimistic, supported by improved risk sentiment and stable Chinese data, though global uncertainty could still limit some gains. Overall, markets are in consolidation mode, balancing strong US data with expectations for slower global growth and potential central bank easing headed into the year end. That's all for this morning's market update. I'm Alex, and thanks for tuning in, and I'll see you tomorrow for more insights.